Hey traders, Raghee here. Welcome to Charts and Coffee for Tuesday, October 26th. Great to see everybody. All right, so a couple things to take a look at. I had a few requests that were sent early on, so I thought I'd grab those. Number one was the S&P. Now, as we head up to higher highs, someone asked me, is this an uptrend in the S&P? And in terms of the tools that we use, yeah, not so much. However, check out the free video from last night where I not only tackle, where the S&P and the Dow are in a very different way from the NASDAQ, but that in this kind of market that based on the 8, 13, 21, and 34 EMAs could largely be considered distribution. Distribution chop doesn't have the same solid support and resistance floor and ceiling as, say, accumulation would. It's more unpredictable. The highs and lows can be just outside what has been previously the range while still being in chop. Chop drives us to the sectors, right? That's what chop typically does. So, I love this update that we have over at countdowntrader.com, and kudos to Trish because I love this update, trading what you see. And this is really where I think all of us can struggle with this. I know that when I start to veer into, well, this is what I think, when I veer into front running the market, when I veer into, this is what's going to happen, and I start to dangerously go into predicting versus say counterpunching, I stray further and further away from the importance of just trade what you see. So with that in mind, definitely check that out when you have some time. Posted that one just last Friday, just this past Friday. So important to remember that in this environment. And the other question so the question was, am I buying the S&P and the Dow? And my answer is no, but there are two sectors, one in the Dow, one in the S&P, and even one in the NASDAQ, three really, where the overall idea is there is an uptrend in the S&P, and there is an uptrend in the Dow, and there is an uptrend in the NAS, but it's not the index itself. And there's a downtrend in each one of them as well, but it's not the index itself. So this is where I say, my video yesterday was there are some stealthy downtrends, but equally there are some stealthy uptrends. That just would have been too long a title. All right, so I have a lot of questions about the NAS. Look, the NAS could easily gravitate to the volume ledge that we have sitting at 15,620. And remember, we're not actually at the top of the range in two ways. If I'm using the most recent top of the range, I'm looking at a read of just above the +2 reading of my V-score. So if you're not familiar with my V-score, all it is a process that I created for myself back in 2008, where I look at the volume weighted average price based on a Z-score, based on the standard deviation. And we still could head a little bit higher, not much. I mean, I think we're definitely inching closer and closer to where we are overbought, but not quite there yet. And I'm measuring this based on volume, on price, and the standard deviation of volume. So I hope that helps. A couple of early questions out there. Hope that gives you a little bit of clarity as to, well, what I see, not what I think. All right. And what we see should really map into what we think, right? Not the other way around. If what you think maps to what you see, there's your cognitive bias run amok. If it's the other way around, you'll likely stay on the path of what your analysis and what your trusted indicators, as I like to call them, the secret squiggles, are telling us. All right. So first question up is if TLT and TBX are still up. Okay, let's head on over to ZB because that's the futures contract for the TLT. So when you say they're still up, why are we soaring to new? Oh, when the interest rate. Okay, so I think I follow Suzanne. So the question is, if these, for example, ZB and of course TLT is your ETF alternative. And in all my cards on the table, we have long puts in TLT. So my analysis, and then that maps to my action, and that is expecting lower lows. So when you say they're up, you mean the percentage, right? So yes, as the ZB and or TLT fall, that's an inverse relationship to interest rates. And I agree. I mean, but here's where correlations can sort of run amok. Is the correlation between the Nasdaq and the bond futures that tight? And you know what? I'm going to actually look over at another screen I have. And let's see, what is the current correlation between the NQ and the ZB or US? All right, right now, it's a positive correlation of a whopping 35. That's a disconnect. So remember that correlations can come and go. So we can look at the TNX, right, as you mentioned, or and see that moving higher. But remember that these are not 100% correlations, and the correlations, like the tides, can ebb and flow. So I hear you. I'm with you. I think that we certainly are seeing a certain bucking of the trend in terms of the expectations for what the bond futures and the Nasdaq futures, or the QQQ and the TLT, are doing. But remember, correlations are not fixed, and this one isn't really all that high either at the moment. It's actually shockingly low. 35 is quite low, to be quite frank. You know, as opposed to, let's say you look at the correlation between the S&P and the NASDAQ, which is almost 90. When you look at the correlation with the NASDAQ and the Dow, which is at 70. So that's their connection, right? Thank you for that. Now, I feel like the bottom is going to fall out somewhere like a roller coaster. Again, you know, I love the question, Suzanne. I definitely have opinions as well, but I don't see it yet. Could the bottom fall out? I'm not going to project ahead. See, this is where we start to prognosticate. And that's where, you know, for me, I know when I start wanting to front run the market, when I start wanting to predict where a market is going to go, I'm veering farther and farther away from my job, which is to know which levels I want to do something at. Or, as I love this image, I do not know what kind of pitch the market is going to throw at me. I only know whether or not I want to take a swing at it. We are counterpunchers, right? So if I remember that, I'll stick with trading what I see. Thank you for the question. And I have no idea. I think it's really important to say, I don't know. I do know that if we get to certain levels and certain indicators give me my signals, then I will act. And until that point, I have to trade what I see. And in a lot of instances, I'm having to wait. Like, for example, would I like to short the NASDAQ? Do I think, I don't know about the rug falling out from underneath it, but could we have perhaps a near term, you know, Charlie Brown, Lucy in the football moment where we slip back down into the range, maybe retest the oversold support around 14.5, 480, maybe, which would be a tremendous trade, right? So that's all I'm thinking. You know, where have we been? And when do my signals tell me that I can do something? So I'm on the NAS, and that's the one most connected to the yield conversation, right? I'm still sitting on the sidelines in that regard, but it's getting closer, right? It's getting closer. All right. Thank you for the question, Suzanne. Tim, how you doing? Good morning. Am I still bearish the SLV? Oh, this has been a tough one. And this is where we always have to remember we have levels that we can consider, and I will have directional bias that I will consider. So the first level that I wanted to see hold was right in the wave. I was wrong. The next level that I want to see hold is the 200. So far, it's holding. Now, what's cool about silver is there is the alternative ETF, SLV, where I do have puts. Even more cool in terms of the puts is their unbelievably low cost. I mean, we're talking options that are in the, you know, $1 and change vicinity. So to take a shot, and I'm not saying a shot as in just a flyer, but to take the short, to take a shot at the short at this level and this level is very low risk because risk is absolutely part of cost, and cost is part of risk. There's no way to separate the two. And I can take a shot at this and have a little bit more latitude for what I believe to be still a bearish market. What do I see? Right? What do I see? Still below the 200. Dominant red grab candles preceded the move higher, and the trend that preceded all of this was a downtrend. So my choices are simple: nothing, or I've got to be short or long puts. So that's the way I look at that. As far as my max loss, absolutely, Tim, I do not veer from that. I think probably one of the most difficult things for traders to take are large losses. You might say, okay, Rog, yeah, thanks for the news flash. Large losses stink. But what I mean is the muscle, mental, quite literally maybe the thumb to click on the muscle it takes to take a large loss is far more than the muscle it takes to take a small loss. Large losses often trip into the whole too big to fail, right? I can't get out now. I'm losing too much. But small losses, paper cuts, as I like to call them. Does anyone like a paper cut? No. Do they sting? Absolutely. But can you continue? 100%. So if we can stick with small losses, and even if we take more than a couple small losses, it doesn't debilitate our account, nor does it mess with our minds. And it's that latter that I think a lot of traders often suffer from, which is that whole shattering of the confidence while your account is down because we took losses that were too large. So we stick with the paper cuts, and I'll scale out, Tim. So if my moderate is past its ability to stay in, I'll scale out of that. If my conservative is still valid, which it is, I'll hang on to that. So we also are using position size as a cost control. What's interesting is a lot of traders will add to the position size in an effort to reduce the cost basis. We don't do that, right? Based on your question, Tim, you know what we do, right? We say, I'll get in here, here, and here. And if this level takes on too much heat, it's cut. If this level takes on too much heat, it's cut. I'm not adding to a position. I'm actually scaling in such a way that we can control risk and not build a larger and larger, let's face it, sometimes losing position. That's where we dangerously wander into adding to a loser. Everything should be predicated on validity, and the validity on SLV very much has to be that 200 for me. And I don't want to see too many more green grab candles. I definitely do not want to see green over green on the JT multi, and I'd prefer for the V score to remain below the mean. That's it. And we found resistance at the mean before. Unfortunately, we're not at the mean now because that would have been terrific confirmation. Can I share the best way to trail a winning position? Alert, yes, and daily. So yes to both of those, Jay. Terrific question. Yes to both. Trailing is absolutely imperative if you want to be a world-class trend follower. And the other part of that is, well, by how much? Because I think we tend to smother our winners. And so I'll back off by that volatility of the daily price movement range. I'll place an alert. Absolutely. I will say, though, when it comes to trailing, I'll start using more often a physical order in the market as opposed to the initial stop, stop loss, things like that. So that's when I'll veer more into a physical order in the market. But a daily price movement range, the wave, previous Darvis, a volume ledge, there's a lot we can consider. Yeah, so I'll use less an alert, but I don't mind having them in. And daily price movement range is brilliant. Absolutely. Hey there, AJ. Where should I set stop losses in aggro entries? Well, if it's an options trade, 13 or 21 is going to be the entry zone. Usually I favor the 21. And the stop's going to be based on premium, right? So if I'm trading the underlying, let's talk about the S&P. If I'm trading S&P futures, I will have a price based on the chart stop. There was a point of validity where if we were to exceed that, I really should not hold the position any longer. But if I have SPY calls, I can have a little bit of latitude around that price-based hard stop. But I also know that I have a little bit more latitude based upon the premium paid. So I'll go with a percentage on the call, but it's got to be a price-based stop in the futures. Good morning. Is there a short setup in ZB? If there is another one, that's great. I'm all for it because we're already short via the TLT. So if we can get a little bit higher, maybe the 21 or into the wave, I'm game. Bring 160. Bring that 160 level. I'm good with that. And then what I'll likely do is do what I did the last time we got up to the wave, which is I will buy the puts in the TLT, and I'll usually short some bond futures as well. So I'll do both. So yeah, I don't think we're there yet, though. Not enough for me. Mud, really close, but not quite yet. Question: is Facebook a short? So, I'm a little surprised that we didn't move up a little bit higher. Maybe I'm not surprised. I don't have any preconceived notion, but I guess I wish we would have gone up a little bit more. And this is beautiful. This area around 340 and change. Yeah, I would love that. Give me a +1 standard deviation on the V-score. Get me into the resistance of the wave. Oh, that would be awesome. But we're nowhere near that. So where we are right now with the VWAPs holding, that would be very aggressive. 329, 330 for a long put. But if it's the bullish momentum, I want to build a long put within. That's tempting. But frankly, I'd love to see maybe one more large candle land us up in the wave. And that would be right as rain for me. So it's definitely more short overall in terms of the strategy than it is. I'm not looking for a buy, but I just don't want to short from where we are right now. So I can have bullish bias. I can expect lower lows, but it doesn't mean that we're at a level that I can do something at currently. So thank you for the question, Andres. Okay, next up, Kay asks, what factors do I consider when choosing option strikes, optimal premium, when the overall market is so choppy? So, Kay, I think you'll find a lot of benefit from the video that I did last night. So there's a lot wrapped up here. Let's unpack the last end of that first. When the overall markets are so choppy, which I totally agree with you, it's more important than ever that we become sector and stock pickers, right? How do we know this? Well, had a decent little trade in XLC, moving lower. Had a great trade in XLF. Had a great trade relatedly in KRE. One is the communications, one is the financials. These are different segments within the index. So it becomes very important to become sector and stock pickers. Another example, we have outperformers like Tesla. And look, I think Henry had a heck of a trade here. So kudos to Henry. I'm with him. Double green pullback, double green pullback, double green pullback to the prop dots. I'll be out in front of earnings. And you might say, well, you missed some of the best ride. That's true. I did. I did not benefit from this, but I did benefit from all of that into that, right? In other words, I've got to be out before earnings, but that's still a decent move there. It's still a really decent move. It's about 120 points. It just happens slower. So this move, because it has the momentum behind it, is going to be great. But what my point is, there are plenty of markets where by the dip, individual stocks, where this is still fantastic. So when I'm choosing strike, now there's the first part of that conversation. The overall market, the broader indices, 100% are choppy. But when we start becoming sector and stock pickers, we can then see where the relative outperformance is, where might there be uptrends, downtrends, and then we could differentiate the chop from all of that. As far as the other part of the question is optimum option strike and premium, my best tactic is to focus on not chasing the market higher with calls and not chasing the market lower with puts, and waiting for momentum and specific levels so I can buy those at the money strikes. I'm almost always in an at the money strike, and that's going to put me at usually no worse. If some of you ask about the delta, that's usually going to put me no worse than a delta 50, and really hardly ever a 70, but in that range, closer to a 50, and that suits me just fine. So that's what I'm usually looking at. Manage momentum, and you will almost always be fine, because you want to think about, is this call or put that I'm about to buy on sale, or is it something in demand where I'm putting myself in a position to possibly overpay? Okay, so I hope that makes sense. And I will see. It's actually, I got to get going. So thanks as always for being a part of Charts and Coffee. I'll see you tomorrow, same time, same station. Get those questions in early. I just go right down the list. And the last question is, do I believe in seasonal factors as a secondary consideration? I don't believe they're false. Simiran, yeah, I don't believe they're wrong. I believe they're misused, abused, and terribly relied upon. Meaning, if I look at a month and I'm looking at the 5-year look back, 10-year, 20, those composites can be very different. So first of all, and I don't say this out of arrogance, I used to do this once upon a time too. Most seasonal interpretation is unbelievably incorrect because it's not balanced views of a 5-year look back versus say a 20. And then also this notion that on a certain day, XYZ is going to happen has to be in line with what the market's currently doing, right? So I think they're wonderful to have. I think they're terribly misused. So, the better you can get at balancing the seasonal with the current market price, the better you're going to understand how to confirm what's happening with tendency. So thanks again, gang. Be good to each other. I'll talk with you tomorrow.